Beirut, October 2019. A man walks into a bank holding a canister of gasoline and what looks like a grenade. He is not robbing the bank, he is trying to access his own money. His son is in the hospital. The treatment costs $5,000. He has $50,000 in his account. The bank will not let him withdraw it. This is not a heist film. It is what happens when a banking system collapses while technically still operating. Within 2 months, every major bank in Lebanon had frozen withdrawals. Accounts remained open, balances appeared on screens, but the money could not be moved. What existed digitally had stopped existing materially. People lost jobs, savings evaporated, businesses shuttered. The Lebanese pound, pegged to the dollar for decades, began trading on the street at 5 times the official rate. The government did not declare a banking crisis. The banks did not officially fail, but the entire system had stopped functioning as a system. This was not the first time. It will not be the last. Fast forward to 2023. Silicon Valley Bank collapses in 48 hours. Depositors with balances over $250,000 wake up to the possibility that their money is simply gone. Within days, regulators step in. The government backstops deposits. The immediate panic subsides. But the mechanism was exposed. Banks hold your deposits. They lend most of that money out. They keep a fraction on hand. When too many people ask for their money at once, the math stops working. This is not a flaw. It is the design. When the design breaks, something very specific happens. People stop asking what their assets are worth and start asking a different question. What still works when the system does not? This analysis will show that across every banking crisis, sovereign default, hyperinflation, and currency collapse in modern history, one category of asset has consistently remained accessible, transferable, and recognized as valuable even when institutions failed. Not because of technology, not because of speculation, but because of a structural feature that most people do not notice until it is the only feature that matters. Think of the financial system as a series of claims. A bank deposit is a claim on a bank. A government bond is a claim on a government. A stock is a claim on a company's future earnings. These claims are useful. They generate returns. They are liquid in normal conditions. But they all share one trait. They depend on an institution to honor them. When that institution stops functioning, the claim becomes worthless, no matter what the number on the screen says. History does not repeat this lesson because people forget it. History repeats it because the system is built to prioritize claims that depend on institutions, and institutions fail. The question is not whether they fail. The question is what continues to function when they do. Let's start with what fails first. In every banking crisis, the first assets to lose utility are the ones that depend most heavily on institutional trust. Bank deposits, government bonds, anything that requires a counterparty to process, validate, or honor a transaction. During the Greek debt crisis, capital controls were imposed overnight. ATMs were limited to 60 euros per day. Bank transfers abroad were blocked. People with savings could not access them. People with bonds could not sell them. The institutions were still standing. The buildings had not burned, but the system had ceased to operate as designed. This is the critical distinction. Institutional failure does not always mean disappearance. It means the institution stops performing its function while continuing to exist. In Argentina's 2001 crisis, banks froze deposits under a policy called the corralito. Accounts were not emptied. They were locked. The money existed in theory. It did not exist in practice. What people discovered in that moment was that digital numbers in a database are not the same as assets you control. The second category to fail is anything that requires complex settlement infrastructure. Stocks, bonds, derivatives. These assets rely on clearinghouses, brokers, exchanges, and legal frameworks to transfer ownership. When the system is stressed, these mechanisms slow. When the system breaks, they stop entirely. During Zimbabwe's hyperinflation, the stock market continued to operate. Prices rose in nominal terms. But converting those gains into anything useful became nearly impossible. The infrastructure still existed. The functionality had collapsed. So what remained? The asset that survived was not the most sophisticated. It was not the highest yielding. It was the one that did not require permission to transfer. Physical gold, not gold certificates, not gold-backed accounts, not shares in a gold ETF. Physical metal that could be handed from one person to another without a bank, a broker, or a government validating the transaction. This is not a historical curiosity. It is a structural constant. In Lebanon, when banks froze accounts, gold jewelry became a medium of exchange. People sold bracelets to pay for food. They traded necklaces for medicine. The metal had no counterparty risk because it had no counterparty. In Cyprus in 2013, when the government seized a portion of bank deposits to recapitalize failing banks, physical gold remained outside the system. It could not be frozen because it was not held in an account. It could not be seized digitally because it was not digital. The same pattern appeared in Greece, Argentina, Venezuela, and every other crisis where institutional access was restricted. The reason is mechanical. Gold does not depend on a ledger. It does not require a third party to confirm ownership. It does not need electricity, internet, or a functioning legal system to change hands. It has what economists call final settlement at the point of transaction. When you hold physical gold, the transaction is complete. There is no clearing period, no settlement risk, no intermediary that can fail. This is not an abstract advantage. It is the difference between having an asset and having access to an asset. During the 2008 financial crisis, gold prices rose, but that is not the relevant part. The relevant part is that gold remained liquid. It could be sold, it could be moved, it could be used as collateral. The system around it was breaking, but the asset itself continued to function. Compare that to mortgage-backed securities. Many of these assets had theoretical value, but when the market for them froze, that value became inaccessible. Institutions holding them could not sell. They could not borrow against them. The assets existed, but they had stopped working. Gold did not stop working. This is not because gold has intrinsic value in some mystical sense. It is because gold has always been recognized as valuable by humans across cultures and across centuries, and that recognition does not depend on a single institution or government. This channel exists to study financial forensics. We analyze past system failures to understand what actually survives, not what should survive in theory, not what analysts predict will survive. What has survived repeatedly when the predictions failed. The pattern is not ambiguous. Physical gold has survived the collapse of every major currency in the 20th century. It survived the fall of the Weimar Republic. It survived the dissolution of the Soviet Union. It survived the abandonment of the Bretton Woods system. It did not survive because it was speculative. It survived because it was the opposite of speculative. It was the asset people turned to when speculation had destroyed everything else. But there are limits. Gold does not generate income. It does not pay dividends. It does not grow earnings. It simply exists and is recognized. In a functioning economy, this is a disadvantage. Assets that generate cash flow outperform assets that do not. This is why gold underperforms stocks over long, peaceful periods. But when the system that enforces cash flow breaks, the absence of yield stops being a weakness. It becomes irrelevant. What matters is whether the asset can still be used, whether it can still be transferred, whether it still holds recognition as valuable when nothing else does. Gold passed that test in 1923 Germany. It passed it in 1998 Russia. It passed it in 2001 Argentina. It is passing it again in Lebanon, Venezuela, and Sudan. The modern financial system has become more complex, but the underlying mechanics have not changed. Banks still operate on fractional reserves. Governments still issue debt. They may not be able to repay. Currencies still depend on trust in the institutions that issue them. What has changed is the speed at which trust can evaporate. In 1929, a bank run took days. People had to physically line up outside the building. There was time for intervention, negotiation, or at least awareness. In 2023, Silicon Valley Bank collapsed in under 48 hours. Depositors moved money digitally. The bank's liquidity vanished before regulators could respond. Speed has increased. Fragility has increased with it. This creates a strange paradox. The system is more technologically advanced, but it is also more vulnerable to the same ancient problem. When trust breaks, access breaks with it. And when access breaks, the question returns: what still works? Right now, central banks around the world are holding the largest gold reserves they have held in decades. This is not a coincidence. It is not sentiment. It is preparation. China has been buying gold steadily since 2018. Russia accumulated gold heavily before sanctions isolated its financial system. Poland, Hungary, and Singapore have all increased their reserves in recent years. These are not speculative positions. These are institutions preparing for a scenario where the existing system does not function as designed. They are not buying gold because they expect it to outperform stocks. They are buying it because it settles outside the system they operate within. This is the same logic that drove individuals to gold in every prior crisis. The difference is scale. When central banks make this decision, it signals something specific. They are acknowledging that the liabilities they have issued may, at some point, exceed their ability to honor them in a form that retains value. Gold becomes the residual asset, the thing that still works when the claims do not. But here is what most people misunderstand. Gold is not a hedge against market downturns. It is not a hedge against recessions. It is a hedge against institutional failure. In 2008, gold rose, but so did Treasury bonds. Both were safe havens. Both were liquid. The institutions were stressed, but they were still functioning. In Lebanon in 2019, Treasury bonds did not help. The institution had failed. Gold was the only asset that remained transferable without institutional permission. This is the distinction that matters. If the system remains operational, gold is often a mediocre investment. It sits inert. It generates no cash flow. Other assets perform better. But if the system stops operating, everything that depends on the system stops performing. And gold continues to function because it never depended on the system in the first place. The current global financial system is built on unprecedented levels of debt. Governments owe more relative to GDP than at any point outside of wartime. Central banks have expanded their balance sheets to levels that were unimaginable 2 decades ago. This does not mean collapse is imminent. It means the system is optimized for stability only under very specific conditions. When those conditions change, the system has less room to adjust. Interest rates rose faster in 2022 and 2023 than in any period since the 1980s. Banks that had structured themselves around low rates found themselves holding long-duration assets that had lost significant value. Silicon Valley Bank was not an outlier. It was an example of what happens when the assumptions built into the system stop being true. Other banks faced the same pressure. Some survived. Some required intervention. The system held, but it held because regulators stepped in to guarantee deposits beyond the legal limit. That intervention worked, but it also confirmed the underlying fragility. The system functions when trust is maintained. Trust is maintained when institutions intervene. Institutions can intervene as long as they have credibility and resources. The question is not whether that chain will hold forever. The question is what happens during the moments when it does not. History has already answered that question. Physical gold becomes the bridge, not because of its chemical properties, not because of tradition, but because it is the only widely recognized asset that does not require a functioning institution to transfer. This is not a prediction. It is a pattern that has repeated in Germany, Argentina, Greece, Cyprus, Lebanon, Zimbabwe, Venezuela, and dozens of smaller crises that never made international headlines. The asset that survived every banking crisis was not the most innovative. It was not the most convenient. It was the one that required nothing beyond itself to remain functional. Let's return to Beirut, October 2019. A man walks into a bank with gasoline and a grenade, not to steal, to access what is already his. The money is still there, in theory. The account has not been closed. The balance has not been zeroed. But the system has stopped honoring the claim. What he needed in that moment was not a higher interest rate, not a better investment strategy. He needed an asset that did not depend on the bank to recognize it. He needed something that still worked when the institution did not. That is not a philosophical point. It is the mechanical reality of every banking crisis in modern history. The asset that survives is the one that never required permission in the first place.